Flash, my AI assistant, continues to like Lululemon stock. LULU is the ticker. And so in full context, I'm the co-founder of Flash. See the link below. It leverages the most cutting edge AI models to help you research stocks. The basic functionality is completely free. You can look up any company in the world, get a report on it, get this AI, analysis of what it thinks, the current technical picture looks like, what does the fundamentals look like. But for a premium feature, we offered we wanted to see how good is AI, because we think that over time AI is going to meet or even surpass human abilities, let's say in the years ahead. And so we wanted to see how it would perform, where we said each week you have to come up with, you can see all the different reports that have been generated on the site, and you have to pick, completely AI picking, the best companies each week. And so it picks a basket of about 6 companies and says, here are the aggressive ones, here's the moderate, here's the conservative, here's why we like them, here's why this AI Flash likes it. And you can see, actually, it's since launching this, just a few months ago in June, it's actually outperformed the S&P 500 and NASDAQ. And so that's each week calling out a couple of ideas. No idea if it'll continue to outperform. No idea, but it's fun to see this, because I am a believer in AI, and I think that it's going to keep getting better. And I want to make these tools available to everybody to use, so that way they can see how good it is. So the basic functionality is completely free. For the premium reports, or the premium, the selection each week, that is a small price. And the reason why I call this out is because it keeps, Flash keeps calling out Lulu. It's called it out 4 times since, we started running this, best ideas in Flash. And, what's interesting is it's saying, look, Lulu has asymmetric upside for a best-in-class retail brand at a bargain price after severe derating due to near-term growth concerns. So it's effectively saying the price has come down a lot. It still has a great brand. Still has solid balance sheet, has this international runway, and there's potential for it to go a lot higher, partly because, hey, management set a low bar for fiscal 25, so that's a potential catalyst this year. Another potential catalyst is either the recovery or stabilization of North America same-store sales. We're going to talk about both of those in just a moment. So I think I understand the thesis, and, this is once again Flash leveraging the most cutting-edge AI models, saying the upside potential is potentially 100 to maybe even 300% over time, over, let's say, the next 5 years, if there's really attractive execution. And it's saying on a quality basis, it's 8 out of 10. So it's quite good. And so I find this to be interesting. I previously did a video myself on Lululemon. I've done a couple. Most recent one was following their first quarter results that came out in June. And the points that really sort of I made it difficult for me was around the growth. And this is my checklist. I use this across all companies. I think it filters out the vast majority of companies. But one of the key, items is you want to obviously find companies that are durable. Now, what's even better than a company that's durable is a company that's growing. Because if you're growing, you're inherently saying, yeah, not only is the business durable, it's going to be much bigger in the future. And so that's why I look for this obvious growth potential. And with something like Lulu, they've called out 3 vectors that might be driving their growth, or could continue to drive their growth in the future. So effectively online sales, getting more men purchases, or men to go into the stores and purchase the clothes. And frankly, I've heard fantastic reviews. I don't own any Lulu clothes myself, but some people have said it's fantastic, feels very soft, it's great, flexible. And then the third is international. So you have online, you have increasing share with men, and international as potential growth. So I understand the narrative, but it's important to say, okay, well, how does this actually, jive with reality? And when you look at the actual numbers, and I'll make myself disappear, it's not as compelling during the most recent quarter. So they reported about 7% growth in the most recent quarter. However, their same store sales, so no benefit from new store openings in North America or in the Americas, actually declined by 2%. So that does reflect that they're losing market share. However, yes, international is growing at a good pace, around 20%. So the international growth vector, that story makes sense. It will be volatile. the online sales, the men's, capturing more men's share, that's not really translating in terms of America's, in my opinion. At least that's not what we're seeing. Or you are seeing it with men's, and it means that the core business, women's, athleisure wear, that's facing even greater decline. So you have these different dynamics that's going on. Frankly, this is what came out with the earnings, when I, did the last video. So this isn't really new, but when I did that prior video, once again, calling out that challenge that, the obvious growth, that's tough for me to say with certainty. That's the narrative that management has. But looking at the valuation back then around 260, I said, yeah, if management executes, yeah, there could be significant upside, maybe 100, 200% upside. But if they don't execute, you're really talking about, dead money for a few years. And so part of this video is to say, well, what does it mean now that the stock has, sold off? You've seen it lose about 20, 30% since that last video where I said, yeah, I can't really, commit to it because I don't see the growth as being obvious. And, I didn't find the valuation to have that sort of asymmetry that I really liked, where I said, yeah, I need to really think hard about putting that capital in. And you can see for years now, it's been dead money, just sort of been bouncing around, losing value. So what have been the developments that's gone on since then? Because, it's one thing to report earnings, the stock drops, makes sense. But how come the stock kept on dropping? What is the news that's driving this subsequent 20, 30% decline? Frankly, it's not a lot of, earth-shaking things. It's not like there's a smoking gun here on why the stock keeps plummeting. I mean, you do have some stories such that Chip Wilson, the founder of Lululemon, he's been using some of his stock as effectively margin loans. So that way he has his stock, instead of selling it outright, he could just borrow against it. And that's one of the common advantages that multi-billionaires have versus the lay class, which is, they can leverage their stock ownership, and that can cover their bills. And so he's supposedly in the last year or two taken out about $500 million against his stock ownership. However, he is using this, at least a fraction of it, about $100 million, to spend on research because he suffers from a form of muscular dystrophy for which there's no cure. And so, if anything, I kind of applaud, I applaud that decision to say, yeah, I'm going to take my wealth and try to figure out cures for these, diseases. So, the first instinct whenever you hear someone like, oh my gosh, look how much money he has, or it's important to remind you, it's very human to have this sort of envy. It's sort of the nature of how, monkey brain is wired. However, you have to take the whole picture. And I think a lot of people, when they go, wow, muscular dystrophy, that's, which there's no cure, that's a very tough situation. And most people wouldn't want to trade seats, even with billions of dollars. So that's, one headline might be causing pressure. The idea that there could be some sort of, margin call on the founder, which case the shares get sold. I mean, you're not seeing that. It's still a fraction of his ownership. No, there is just general retail weakness. You've seen Target stock. That's another retailer. The shares have fallen recently, talking about how their sales have fallen. I mean, you have this common theme of a weaker consumer, maybe an impact from tariff. And I think another key aspect, which is that even if there isn't a lot of news around Lululemon, just having the bad results and not having a narrative that really gets Wall Street excited, it can get the momentum going in the wrong direction. Just like you can have a stock like Palantir, where the story is going so favorably that the momentum just keeps going in terms of valuation expansion. You can have the other aspect, the other, side of the other swing of the pendulum, of where you see a contraction, it just keeps getting worse, because there are three drivers for a stock. There's the cash flow to you, that can be returned to you via dividends or buybacks. There's the fundamentals like sales growth and profit growth. And then the third factor is valuation. How does that swing over time? Over a multi-year period, valuation really doesn't change much for the indices. As over a multi-decade perspective, the benefit from valuation is very small, because you generally stay in a range, 15, 25 times. It doesn't, you do get outliers, but it doesn't, for the most part, unless you're having really crazy macro, it sort of stays in that range. And so I think another key aspect of why has Lululemon shares just continued to get hammered is because you get the negative momentum where you have this contraction in valuation, and you can see it now trades at the lowest valuation that it's had since the great financial crisis. It's trading at under 7 times EV to EBITDA. Generally, just for bargain hunters, 8 times and under. Buying as a basket, companies at EV to EBITDA 8 times and under have, the studies have shown, I believe Tobias Carlyle in his book about value investing, has shown that 8 times and under EV to EBITDA effectively has outperformed the market. And so this is an interesting, signal, as, this is getting into that deep value territory with the valuation. So the question is, do I agree with Flash in terms of, that Flash keeps calling it out for 4 times. Should I make it part of my own investment journey? As always, none of this is financial advice. I don't own any shares of Lulu at the time of this video. Also, a quick plug, Sikander, a premium unrivaled subscriber, wrote, whenever I get this notification, I stop whatever I'm doing to watch it, even if it's past midnight here. He's talking about the exclusive posts at Unrivaled Investing. This follows Pinkle, a premium subscriber who said, I've been with you for a year and it was a game changer for me. Thanks for creating this service. We have an excellent community. If you're looking for compelling ideas, come check out Unrivaled Investing. And so as we think about, previously at the very start of this video, Flash called out a couple of catalysts that can result in the stock re-rating. And one of the catalysts was management has now set expectations lower so that if they beat or meet these expectations, the stock could rip higher. And I frankly think the stock price has fallen to a point where Wall Street doesn't believe, or at least the market is pricing that Lulu will not deliver on their guidance that they provided just a few months ago. And their guidance says 5 to 7% revenue growth, so not crazy compelling growth, more GDP, a little bit GDP plus. And they're saying earnings of around $14.60, $14.70 per share. That's what they're saying. Now, $14.60, $14.70 a share, when the stock's just, slightly north of $200 a share, means that it's around 13, 14 times earnings. So I really do think, when you're at 13, 14 times earnings, if that earnings are real, and it ties to real free cash flow, which it does for the most part with Lulu historically, you're talking about a 7% plus type of yield that can be going to you as a shareholder. So that is, now you're talking about very interesting territory, because if you get a 7% free cash flow yield, the way to think about it is 1 divided by 14. So you're getting that 7% plus you're able to get some sort of growth, let's say 5% growth over time. Then you could be getting, a teens plus type of earnings return. So this is an interesting sort of development. I think the fact that it trades at 13, 14 times forward earnings reflects that the market, as I said, doesn't quite believe that they'll hit it. They've seen targets, terrible numbers. They're seeing concerns about weak retail. So they're saying, I don't even know if you're going to do it. If they do reaffirm and show they're well on track for this earnings range, even with the possibility of beating it, then I think it wouldn't surprise me to see Lulu stock, see some sort of quick rebound from, let's say, 200 to 250 or 300 type of share price. That's the potential that it wouldn't surprise me if you have that sort of near-term development. Now, how about running it through a hypothetical framework? Now, of course, stock price can go higher or lower, depending on macro, depending on management's execution, depending on so many different variables. But here's this hypothetical framework now running in the current price, just north of $200 a share. I haven't changed the assumption. So it's still, assuming effectively the same margins, growth rates, multiples. Truthfully, I think I would no longer consider the 7.5, the base and high case. I would sort of scrap those, just focus on low. Do I think low is achievable? And looking at this low case, margins might be high. Last quarter was closer to 18, 19%. So this might need to get tweaked lower. So the margin expectations might need to get tweaked lower. But just the fact that it's trading where it is, which is, as I already mentioned, 13, 14, maybe even 15 times, depending on how bad this year is, you are talking about 6, 7% yield to you as a shareholder. So if you're getting that growth, as I called out, maybe even a little bit of multiple expansion from, teens to, 15 times, then you're effectively talking about, low teens types of earnings multiples. So this is the question, is how confident are you? This is if you want to, follow or, say, hey, this Flash AI, it's pretty interesting. I'm inclined to agree with it. You're inherently making a call that you believe that they're going to deliver at least 5% growth going forward. For me personally, I think it's just too hard for me. I look for things like I just did a letter for my subscribers, and I'm sort of sharing like, here's a point that management has provided. Their growth is closer to 30%. And for these data points, this is why I'm confident, or at least I think it's likely, that you have a low teens type of growth for the next 5 to 10 years at the very least. And that's sort of my framework. Whereas for Lulu, the durability and obvious growth of this business is much harder for me to assess. Is it possible you have some sort of new paradigm where they say, yeah, we want to try to keep growing, but it's at the expense of margins. And you see, margins come under pressure. So this is an example where I'm probably going to disagree with Flash, where I'm going to say, you know what, it's not part of my journey. I'm not going to pull the trigger. It wouldn't surprise me, though, if it works out. Wouldn't surprise me if it's $300 in the next year. But it is interesting to see. Flash is saying, yeah, this is a compelling idea. Of all the ideas it's looking at, this is one of the 6 that it called out this past week. But I don't think it's quite ready for me. I don't think it's right for me. And that's okay. Everyone's going to have their own investment journey. You have to figure out what's right for you. For me, retail is just so difficult, just because... for example, it comes down to consumer behavior and why they're going to keep buying, the Lulu pants and clothes and shirts. And I don't have enough of an insight to say, yeah, this is what's going to drive it. Or for sure, they're going to keep paying, and have this, very nice profit margins for Lulu. It's too uncertain for me. And there's been enough history with retail that these types of brands, they change over time and consumer preferences change over time. So the durability, let alone that obvious growth, isn't there for me. That said, I hope this video calling out Lulu, calling out Flash, how Flash thinks Lulu is quite compelling. I hope it's been helpful for you. Check out Flash. It's completely free for you to use. The best ideas each week, that is a premium feature, but otherwise, any company in the world, that's for you to check out. Thanks so much for watching Unrivaled Investing.